There are plenty of uncertainties for markets right now, but are these also reflected in risk volatility? With me with his thoughts on this is Max Kettner, cross-asset strategist at Commerzbank. Max, we're coming up to a Fed policy meeting. There's a lot of disconnection between Fed rate expectations and what the market expects. Should we be worried?
Yes, I do think so. I think when we look at volatility at the moment, it's very subdued, right? It's very, when we look also after the Brexit referendum, how equity volatility, for example, came down very abruptly. That is unusual for the sort of risk events that we have to face in the latter half of 2016 now.
Okay, well, let's look at volatility. First chart here. Let's explain the extent to which volatility has been actually pretty benign for quite a long time, but it's starting to pick up again.
Yes. The first key aspect is that you see the Eurozone volatility, particularly equity volatility, nowadays structurally higher than US equity volatility. That has to do with the changed correlation between the Euro and Eurozone equities. Right nowadays, the Euro is very much acting like a safe haven, and that puts a dampener on equity prices in the Eurozone even further. And then also the Eurozone equity volatility is higher. So that's the first aspect. The second aspect, however, that I just alluded to is that after the Brexit referendum, volatility was coming down quite abruptly. And I think when we also look, for example, on these 43 consecutive days of the S&P 500 trading within -1 and +1%, that is unusual for the risk events that we have to face.
And US data is having what impact?
I think the US data right now, that is a very, very interesting point, particularly when you compare it to what is happening on the equity market. What you see in the second chart is that usually there have been quite some lengthy cycles of how these economic surprises in the US affect US equity prices. That's not to say these regimes will hold on for 3-6 months, but they've been relatively lengthy. Since the end of April, however, these moves have been very, very erratic, meaning that the market at the moment cannot really figure out how to deal with economic data.
It's not really pricing it effectively. It's definitely pricing it, isn't it? But it's not doing it in a direction that suits the Fed?
Yes, basically what the market right now, particularly the equity market, is trying to figure out is how and what impact does economic data have on equity prices and ultimately also on the Fed. So is really good news, and does it mean a Fed rate hike, or is good news bad news? And as you can see from this chart, since end of April, we are flipping around very, very erratically in these small regimes.
The final chart, perhaps Max, you can sum up the market mood and what is really driving the market. It's the Fed, isn't it?
Yes, absolutely.
And this chart shows us that?
Yes, absolutely. This chart shows the 20-day correlation between US equities and US treasuries. And you can see that this correlation has reached levels that we have last seen in 2007. What it does show, however, and what is even more important, is in conjunction also with the subdued volatility, that right now markets are very much in an environment that I like to call a high consensus, a low conviction environment. Hence, investors are going into trades, into momentum trades, speaking of, for example, going long credit, going long emerging market debt, going long EM equities, going long gold, for example. All these trades that have worked in the past few months, and then investors are hoping that the positive momentum will carry on.
Max, what's going to break it? Is it going to be a bubble that we should all be worried about? What's your major bubble worry?
I think it's, as you said, very much the Fed in the next coming days. And that is also, I think, very, very important for this chart here. Is it going to break this very high correlation between US equities and US treasuries? Because in this high consensus, low conviction environment, people were, of course, also loading up on US equity exposure and US treasury exposure alike. So they were increasing duration and increasing their equity exposure. And obviously with rate hike expectations looming, then also this correlation gets so high.
Does the Fed hike rates this year, let alone
Yes, in December. We think it's going to be December.
Max Kettner from Commerzbank, thank you very much.
Thank you.